Thanks for joining us on Power Lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Dugal. Let's get straight to the headlines. Indian markets touch a 3-week low. All sectoral indices trading in the red. Tata Steel and Aurobindo Pharma are the biggest losers on the Nifty.
Cafe Coffee Day falls the most in 2 years after income tax raids. The founder has undisclosed income of 650 crore, says the taxman.
Bloomberg analysis shows that Tata Motors is sitting on $6.2 billion in cash, up 87% from last year. The money may be used to expand businesses, make new acquisitions.
Shoppers Stop gains more than 15% after Amazon chooses the retail chain as its first brick-and-mortar investment in India. All right, let's do a quick check on how the markets are trading at this point in time. Neeraj is standing by to take a closer look at what's happening in the markets across different pockets. The weakness persists. What are you making of it?
Yeah, so not global in nature,
Yeah.
we might add today, because today Europe is fairly flat. Dow futures are trading mildly in the red. So we have our own problems to contend with, down 1%. India VIX, we've been talking about it, has surged about 5.5%, if I'm not wrong, to 13.5, 13.3, 13.4 India VIX in the session today. So volatility has gone up. Now you could argue maybe it's because of expiry or maybe or whatever it may be. But yeah, F&O expiry week will see heightened volatility. But I think speaking to a bunch of market experts, the key monitorable seems to be the Bank Nifty, which has been weak the last few days. Today, while none of the top 10 names on the index are not losers, are not banking names, but Bank Nifty is cracked 300 points, if I'm not wrong, on the downside. And I think this 24,000 remains a bit of a key monitorable, a lot of options around that level. So let's wait and watch if indeed Bank Nifty breaks and that takes the markets down further or no. So that is one. But commodity stocks are under pressure, guys. Tata Steel, Ambuja, a bunch of other stocks are top losers, and mid caps have a flurry of activity as well.
We've been talking about overheating concerns for a while. Are you seeing the pressure on the mid caps and small caps a little more than what we're seeing on the benchmarks?
Yeah, so par for the course, if the index were to correct about 1%, you'd probably see these mid caps and small caps and Bank Nifty correct more. But the nature of the fall, guys. So, well, Infibeam is a separate case in point today. But look at what Indiabulls Group stocks have done the last 3 or 4 sessions. Today, all of them are down, by the way. But if you look at what these stocks have done the last 3 or 4 sessions, Indiabulls Ventures, a stock that only went up, is down on 4 consecutive circuits. Indiabulls Housing Finance is down 2.5. Indiabulls Real Estate from 250, 255, 260 down to 202. We've seen Bombay Dyeing correct and come off for about 3 or 4 sessions. So the broader markets are really correcting thick and fast, and that doesn't come as a surprise. The only exception today, of course, is Shoppers Stop, but that's because of a deal. But look at Infibeam as well. I mean, you would believe it's a casino or a game. The stock was down 37% at a point of time, then 20%, and that's the chart. Now down just about 8.5%, and I'm using the term just because it was down over 30% at a point of time. And then, of course, Cafe Coffee Day or Coffee Day Enterprises on this whole talks. So market doesn't like a piece of bad news right now at all. Some rumors, some talk, something which is negative coming about, and the stock is off in the session, as is the case in today's session as well. So Coffee Day 2 down about 9% in the session.
You were also talking to Nilesh Shah.
Yeah.
What's the mood like? Forget the the immediate movement of the market, but is the overall feeling long-term positive?
So he's a bullish man by nature, and therefore he doesn't quite come out with too much of a bearish tone. But I think after a really long time, I heard him say 2 key things. One is that the macro, which was good until now, seems to be on the path to becoming worse, and therefore the micro needs to become all right too quick too soon. And any recovery that we see might only be subject to a few things that the government needs to do. If those don't happen, then you don't know quite what the downside would be. But speaking of Nilesh and that conversation that I was having with him, let's hear out or let's listen into a slice of the conversation with Nilesh that we had earlier today.
There's no doubt that markets are fairly priced. In fact, they're a little bit above fair price. But with macro, which is different in 2017 versus 2008, and the hope for the future that things can be better, I think we can't say that markets are expensive or bubble. They are little above fair value, and either a time or price correction or both will kind of adjust it. For FY19, for our portfolios, large cap, mid cap, small cap, the range is from 12% for large cap to about 18-19% for mid caps. Yep. But this is for the FY19 growth, because FY18 is now just 6 months away. And clearly there is little bit of uncertainty in the September quarter. June quarter was impacted due to GST implementation by destocking. The restocking should occur for the festival season from Dussehra, Durga Puja, Diwali. There's a mixed signal coming. We have to wait for full festival season to play out in order to take a call as to what's happening in September quarter.
Right. Much debate also on the outlook for the Indian economy. The debate, of course, is around this whole national stimulus, some sort of economic stimulus that the government would come up with. The Prime Minister is due to address the BJP National Executive today. There is some talk that there would be a stimulus package announced, but no one clear on what the actual components of that stimulus package would be. Markets from the bond and currency side are a little bit nervous. So if you pull up the bond yields for the day, you'll see a little bit of a downtick on the 10-year yield, but it had moved up on Thursday and Friday, fearing that the government may give up on fiscal consolidation. The currency had also reacted to that because foreign investors in particular are very, very nervous about fiscal expansion, particularly given India's history with fiscal stimulus, which has not been going well. In fact, the economists fraternity is also coming out with fairly measured statements. I'm going to pick up on one view coming in from Kotak Institutional Equities this morning. And in their note, they talk about the fact that the fiscal position simply does not allow what they call a bazooka stimulus. They instead say that the government should focus on specific measures, and what they mean by specific measures is not really sectoral measures, but for instance, if there is pain coming from the informal economy, is there a way to bring in some sort of financial or taxation benefits to ensure that the informal economy doesn't hurt any more than it is already? They also talk about residential realty, which of course the government has been doing for a while from the affordable housing front, but they do say that that is one sector, actually for the lack of any other ideas, where you can bring in some sort of stimulus. But almost all economists staying away from any large calls for fiscal stimulus.
I mean, a bazooka is usually to destroy, isn't it? Not to build something. But the finance minister has been sort of poo-pooing the idea of a stimulus.
Yeah.
He was at the Bloomberg India Economic Forum on Friday, and he says India needs to find a balance between fiscal prudence and spending, and there is no reason, there is no need to panic at this juncture. That's the finance minister at the Bloomberg Forum on Friday. Listen.
Comes the final issue of the point that I make. How do you maintain the balancing act between continuing to spend in an economy, continuing to support your banks and strengthen them, at the same time maintain some of the best standards of fiscal prudence? And I think that last part is the current challenge that we really are facing. And this seems to be the logical course in order to get back. I don't think there is any need for panic. There is certainly a need for analysis and for responsive action to this. And we are fully prepared for it.
All right, let's see how that plays out. We haven't heard anything from the Prime Minister so far. Moving on to corporate news, Amazon's investment arm is buying 5% stake in Shoppers Stop. You already know that. Shares worth 180 crore will be allotted on a preferential basis. Agam Vakil is standing by with a little bit more of the analysis behind the deal. What it could mean perhaps for both parties. Agam.
Sure, Ira. So what I was going through was what and how it benefits both the parties. As far as Shoppers Stop's concerned, it's raising nearly 180 crores when it will get to use these funds to invest in its current stores and also expand the number of stores. And moreover, and perhaps more importantly, only 1% of Shoppers Stop's total revenues comes from digital sales. Amazon will help Shoppers Stop list about 400 brands, and this will bolster its online sales, and that's how it helps Shoppers Stop. As far as Amazon is concerned, Shoppers Stop gives them the physical presence, and by that I mean that Amazon will set up experience centers in each of these Shoppers Stop stores, and of course, Shoppers Stop will also give Amazon access to unpenetrated, unorganized fashion retail sector, which should aid both Shoppers Stop as well as Amazon going forward.
Agam, hold a thought. Alex spoke to the MD of Shoppers Stop, Govind Shrikande. Here's what he had to say on what he'll do with the funds that he raises from Amazon's investments. Listen in.
I think we are on a path of continuous growth, and we believe that the Indian retail the physical side as well, is still underpenetrated. So I think this will help us to further invest more, and we are going to open about 5 stores in the second half of this year, and there's a plan of another 15 stores for the next 4-year period.
So most of it is going to be used to bolster the infrastructure.
Expand the footprint as well.
And this has nothing to do with the investment that you talked about with regard to Hypercity. That's a completely different story
Absolutely
altogether.
different, correct.
What's the update on that?
So Hypercity, as you're aware, we have been talking to multiple investors over the last 24 months period to bring in investments into that business. As of now, we are in, I would say, the final lap of discussion with a few players, and I believe that we are confident of announcing the next step in about 4 weeks' time.
Agam, just coming back to you quickly to try and understand how Shoppers Stop stacks up against the other listed fashion retailers.
Right, so I was actually looking at projections in terms of revenues. For FY19, it comes between Future Lifestyle and AB Fashion at a little less than 6,300 crores, but its profitability is expected to be a lot lower than its two peers. Why? Because of operational margins expected to stand at around 6.4%, as against nearly 10% for AB Fashion and Future Lifestyle. Moving on, in terms of valuations to, for Shoppers Stop, it stands around nearly 31 times, which is more or less in line with its other two peers at around 29 to 39 times. And in terms of number of stores, this of course will vary on the kind of format that each of these players wants to. But Shoppers Stop for now has nearly about 99 stores as comparison in comparison to Future Life, standing at 372 stores, and well, AB Fashion is standing nearly at 2,300 stores. But on the whole, Shoppers Stop does have an advantage when it comes to valuations.
Agam, thank you for that. Let's get in Harminder Sahni, founder and managing director at Wazir Advisors. Harminder, thank you so much indeed for joining us on Bloomberg Quint. You track this space quite closely. What does Amazon get by partnering with an offline retailer?
See, internationally also, Amazon Fashion is one of the most aggressive moves which Amazon has made in the recent time, and it's doing extremely well for them. And I think they clearly see that opportunity to build their fashion business far bigger and wider in India, because in India, fashion is the most organized category, most branded category compared to only FMCG category, one can say, that has more share of organized and branded. Apparel has the largest. And in terms of Shoppers Stop's presence and Shoppers Stop legacy brand as a multi-brand retailer in the offline space is unparalleled. They are the best player in that category. We have Lifestyle and a couple of others too there, but Shoppers Stop is the most credible player there. So what it does is that Amazon Fashion gets this opportunity to be in the offline, present their own brands in the system, offline system, because otherwise their private labels and the brands which they are building in online world, even though they are growing very, very fast, but they're still addressing a very limited percentage of India's population. And Shoppers Stop allow them to reach out to the, let's say, remaining 90% plus people who primarily shop for fashion in an offline world. So I think that's what Amazon gets from getting into Shoppers Stop, bringing their Amazon Fashion brands.
So specifically, is this becoming a trend? Are online retailers, requiring an offline presence, specifically in the fashion category?
Yes, I would say, see, in my mind, in the business, there are two things only. One is the business, which is the brand. Part is the brand, and the other side of the business is the consumer. And channels are primarily the medium to connect these two. So some people who were, I would say, traditionally in the offline world when online didn't exist, so they are in the offline world. And then there are players who have started from online, and obviously a lot of funding and a lot of excitement in that space which has happened. But primarily the business is bringing brands to the consumers. And any serious retailer or any serious brand company at any point of time would not like to limit themselves in a particular market because of their channel choice. They would like to reach out to as many consumers, whichever channel makes them reach there, they will take it on. So I think that's what's happening, that Amazon has very steadfastly and with a single mind focus built their online business in the US and in the other parts of the world in an online way, through acquisition of Whole Foods in case of food market in India, which is in US, which is very mature and very exciting for them. They have gone into that. In India, probably they are looking at it in the fashion in a similar way. But just 5% stake as compared to 100% buyout of Whole Foods, I think maybe they are taking baby steps to figure it out here and put their finger in the pie. And like I earlier said, that the immediate benefit for them is to bring their Amazon Fashion brands into offline space. by taking this strategic investment into Shoppers Stop.
Okay, so you don't see any conflict of between the prospects of Shoppers Stop's private labels and Amazon's private labels. They're not competing in the same space.
See, they may be, but as retailers, they know very clearly. When you are a brand company, when you have own brands like Urban Brands or like Raymond, when you have brands, then you worry about these conflicts. But when you are a retailer, you carry all kinds of competing brands in your portfolio all the time, and some of those happen to be your private labels or your partners' private labels. I think you can handle that because as a DNA, you are used to handling conflicting brands in the portfolio at any time. Because what you are trying to do is bringing a wider range of products and brands to consumer and allow consumers to choose whether they like an Arrow shirt or whether they like the Louis Philippe or whether they like a private label brands from Amazon or from Shoppers Stop. You allow consumers to make that choice.
Make of Shoppers Stop online strategy so far, and how do you think they would benefit from this alliance of sorts?
See, Shoppers Stop, if you ask me, they have been pioneer in terms of even bringing a multi-brand online store into being way back in late 90s and early 2000. But I think they have seen, they may have accepted it that it's a different business which is driven by technology and less driven by your buying and merchandising skills, and bringing the technological power of Amazon along with them. So probably they are securing as a I would say, very intelligent and smart company. They are securing that partner, this channel. If you can't do it on your own, why not join hands with the best in the game?
Harminder, we leave it there. Thank you so much indeed for joining us. Harminder Sahani from Wazir Advisors.
Let's move on to Tata Motors. Total sales have been declining for the past 3 quarters, but that hasn't stopped the car major from building a larger cash pile. The Tata Group company's cash reserves have gone up by 87% over the past 1 year. That's data compiled by Bloomberg News. PR Sanjay, who's joining us to help explain what goes behind that number crunching. Sanjay, actually interesting and surprising, right? I mean, we've always talked about the stress on Tata Motors. Clearly that, if this is one indicator, that has turned around a little bit.
So, it's indeed surprising when you take the list of cash, cash at hand of Indian corporates. Of course, Reliance is far, ahead of all the, list. But when it comes to Tata Motors, which is, consistently making losses, and you would be surprised to see that it is, ahead of the, pack. So it's largely due to JLR, which is a mainstay, which is a money-spinning business for Tata Motors. So as a consolidated, balance sheet, Tata has a lot of money just because there are few things about it. So they're now launching out a lot of new models, including a lot of SUVs, and I-Pace, all electric vehicles is coming, and autonomous experiments are going on. So they need a lot of money, and they're also building a Ukraine plant. So they need to boost up manufacturing capabilities because competition is getting more intense and it's worse. So if at all JLR want to actually stand up or put up a brave fight, they need a lot of money. So we spoke to management. Management is very clear that in case anything happens untoward or unexpected, they need more money, and they are present in 170 countries. So, and of course, auto businesses also faces the risk of cyclicality. So they want to, in a world of competition, they need to have some money ready in case if there's some exigency coming. So that's the basic philosophy behind Tata Motors to have being conservative when it comes to treating cash.
Sanjay, thanks so much for that. That's an interesting turn for Tata Motors.
All right, let's talk about Europe. Europe is making headlines today. Angela Merkel wins a 4th term as the German Chancellor, while Moody's has downgraded Britain's rating. What does this mean for global markets? Let's find out from Mark Farrington, Managing Director of Macro Currency Group. Mark, thank you so much indeed for joining us. What do you make of risk appetite now? There's been a bunch of political developments in Europe. How is the market reacting to all of this?
Well, the market has been reacting in a subdued way, as it has all year, in the face of political risks and even central bank risks. So this is certainly not an overreaction. I think that what we're hoping for is sometime between now and the end of the year that the market starts appropriately pricing in the developing, peripheral risks that we see on both central bank policy and geopolitical risks.
Mark, specifically on the euro, is the markets thinking that with this sort of fractured verdict and the fact that the far right seems to have made inroads, that Angela Merkel's government could be a little bit susceptible to policies the far right may want to push? Is there sort of a slightly more medium-term implication for the euro there?
Well, I think the market was priced for perfection going into this, following the French election and the sort of euphoric victory of Macron in France. That political risk was priced down to zero, and I think that the market went into this election thinking that there was really no political risk left in Europe, and we had always argued the opposite. The populist parties had continued to make gains in both the Netherlands and in France, so there wasn't a story of reversal of populism. There was just a stronger party outcome in France. In this case, I think the headline reads the same. Populism is a rising trend in Europe. It is a worry. It's going to pin in the campaign pledges that Merkel can make with a four-party coalition. So we just need to wait to see these negotiations play out and see where the compromises will be. But surely it'll be on immigration policy. You see Turkey selling off this morning because Turkey is probably at the front of the queue in terms of a shift in policy stance required by Merkel. But then eventually issues such as the debt overhang on Greece and other issues like the Catalan referendum, which is happening on the 1st of October, can also be influenced. So we're just waiting to see where the next dominoes fall, actually.
So I understand that Draghi is also scheduled to be addressing U.S. lawmakers in Brussels today. How is the market looking at all of this, Mark? The point I'm making is this a feeling that things are getting better, or is it a question of things perhaps getting only worse?
Well, growth is definitely getting better, and this has been confirmed now by a very sticky and consistent elevated level for the manufacturing surveys, not only in Europe but everywhere. So this has probably been beyond central bank expectations and taken as a positive. What hasn't improved very much is the inflation environment, and with the 10 to 15% rally in European currencies relative to the US dollar year to date, we are going to see the effects on imported inflation. So undershooting the inflation target will continue to be part of the story that restrains normalization, and Draghi is certainly leaning in that camp. So he will probably take this opportunity to try to talk down the euro a little bit and warn of its effects on the disinflation trend.
What about the story playing out in Britain and on the pound? Any impact of the ratings movement on the pound this morning?
No, I don't think so. The rating downgrades one notch or a status here and there, negative versus stable, etc., tend not to have much effect on developed market countries. It would only be a precipitous drop, 2 or 3 notches lower, and a negative outlook that would create some concern in the minds of, say, reserve managers or very conservative bond fund managers around the world. I think it's just the rating agencies doing their job, which is to take note of the change in status quo and flag the risk to the sovereign, and then hopefully that has a positive influence on policy making. That tends to be the role that they play with small downgrades like this.
Now that it's very clear that integration into euro is going to be put on pause at this point in time, where would you see the near-term target for the euro? Some consensus, some numbers thrown on the Bloomberg says that about 120, 121. Would you broadly agree with that number?
No, I think we would have the opposite view. As I mentioned, going into this weekend election, European equities and the growth view on Europe were priced for perfection. People have really discounted all risks. There has been a desire to focus on the positives and one by one dismiss any particular negative stories that are emerging, including the mounting geopolitical risk around Korea. The market has tried to convince itself that it somehow doesn't have any influence on Europe, which is not correct. It's one of the biggest geopolitical challenges for the whole world in 50 years, and Europe will not be divorced from that. So I think the positioning is wrong-footed. The growth story is already fully priced in and planning at a very high level. So all risks are asymmetrically skewed to the downside, and it'll be very difficult to develop a story that's more positive than we already have priced in for Europe. What you could have is some shocking negative news in the US, for example, which might continue to push euro-dollar higher. But we also have a market which has done its best to price all negatives into the US story. So I don't like the risk-reward. I think it's asymmetric to the downside. And in terms of valuation, euro-dollar is right in the middle of the range. So there's not a valuation argument to make either way.
I have one final question, Mark. So if all that action that's happening in Europe, how would you look at the emerging market basket of currencies right now? Would you consider investing in this part of the world? Would you have a view on the rupee?
Well, you know, India has been the darling of the market for the last 18 months or so. So I think eventually some profit taking was due to take place there. We were very bullish on India last year and held a view of stability for the first half of the year. It's just now we've come to this late cycle environment where we are going to have bad news instead of a continuous run of good news like we've had this year. And there's going to be corrections. So the corrections are going to be larger in the places which have run very strongly, have the largest positioning, or actually have some very pointed bad news in their part of the world. So in the case of India, I'd say the news is relatively positive. It's just an exhausted trend with a high-level positioning. So some positioning washout is likely. I wouldn't take this as negative. I would just choose the levels which you might want to rebuy and average into India, because the growth story, the geopolitical story, policy execution, everything remains quite positive for India.
Right, Mark, appreciate it. Thanks so much for joining us with that view. That's the global currency markets, lots of action there. We'll slip into a quick break. Thanks for watching Power Lunch.